Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, June 20th, 2013. And in this video, which should be a very brief video, I just wanted to talk a little bit about the momentum in the market. I recently posted a chart. I've been posting quite a few of the ascending channel in the SPY or the S&P 500 on the daily time frame, and I recently made a post making a case for how the momentum is waning, how prices are now beginning to spend more time in the bottom of the channel. And as I pointed out this morning, prices have now gapped below that channel and remain below there, which is a technical breakdown. So let's take a longer term view now. This is a weekly chart of the SPY, meaning every candlestick represents 1 week of price action, and this encompasses the entire bull market since the March of 2009 lows, where my cursor is over here on the left. So we're looking at several years, the entire bull market, and we're going to look at one of my favorite. This is a very popular indicator. A lot of traders out there use it, and there's a reason for that. It's just a very accurate indicator on helping you gauge future direction of the market or the future trend by looking at the momentum in the market. It's a momentum indicator, and at times I'll use the PPO as well. Let's just throw that up real quick. The PPO works very similar to the MACD. Some of you will notice on my weekly and monthly charts I prefer a PPO. The PPO is virtually identical, except it does a better job at capturing price moves over a longer period of time or very large price moves. Let's just jump away from the SPY real quick and look at a stock like Netflix. Netflix had a monster run over the last few years. We'll go back all the way to 2004. And here's the MACD up top and the PPO on the bottom. And as you can see, the MACD is virtually flat in those years that Netflix was having a very powerful run. And now we're looking at a log chart. It might not appear so powerful, but when we look at a linear chart, this was the run that we had in Netflix. And of course we had a heck of a correction lately, so let's just back that out. So let's say one was trying to use the MACD and the PPO during this move here. You'll notice that the MACD was virtually flat, very hard to make heads or tails of, whereas the PPO does a better job. You can see the separation between the signal line and the PPO line, or the fast and slow lines, whereas you don't see much separation there on the MACD. So again, for larger time frames, I tend to use the PPO or stocks with very large price moves. But in this case, we're going to take a look at the SPY only going back a few years. So I'll go ahead and use the MACD here. Let's put this one back up and go back to the SPY. Okay. Zoom back to the time frame I'm focusing on, 2009 to present. Okay, so now let's dig in and take a look here. And what we're looking at are the sell signals, the bullish and bearish crossovers. When you have the signal line cross over the MACD line, when it crosses down below, that's a bearish crossover. And the histogram for the MACD, it gives you an idea, or will tell you when that cross has been made, and you can really zoom in if you want to on your computer, but at an easier glance you can just take a look at the histogram down here, and anytime it goes negative, that means that the signal line has now crossed below the MACD line. So what do we see here? Every time that we've had those crossovers, without fail, since this entire bull market began, it led to additional downside. So what I'm doing, if you'll follow the horizontal line as I do these crosshairs, I'll put it on the first red bar. That's the first weekly crossover. And given this one wasn't the deepest sell signal, it still did. There was additional downside from that first candlestick bar. And again, when you're in scaling this, you're talking a period of weeks here. That was definitely a profitable short trade had you used that. Now I do want to clarify, I don't use MACD crossovers as standalone sell signals or buy signals, and for that matter there's not any one indicator that I've ever found to be a reliable 100% or 95% or better buy or sell signal. But this, used in conjunction with other technicals, gives us a good idea where the market's likely going forward. So that was the first one, little correction there. Follow again the the vertical line. This was the next one. We're looking at the flash crash here back in 2010. So that would have been hard to get in and out of because you'd have to wait. The key with these signals, we're using a weekly chart. You need to see a weekly close below the zero line to confirm the signal, and that would have been hard. But with that being said, at the end of the week, prices did close right up here. You know, you have a tail on this candlestick, but prices closed here at the body. So that would have been your short entry, and you had considerable downside from there. So again, an effective signal. There's 2 for 2. Follow it here. There's your sell signal when the MACD went into negative territory, bearish crossover, and this is where prices bottom down here. We move forward once again. Another sell signal and several weeks of downside, and finally again, there we go. So there's 1, 2, 3. I'm counting to the right of my the right of the vertical line. I'm seeing 3 additional weeks of selling there. And where are we now? We do have, of course, we have another day to go, or I should say 2 days. This is early Thursday morning I'm doing this video, but we do have the MACD as well as the PPO. We have made a bearish crossover on the weekly. Again, if there's some type of stick save and the market manages to rally hard into the close on Friday, that signal will be negated. But something else that I note, if you look at the slope and the trend of the histogram, that's another very useful tool. Other than this point where the flash crash came pretty much out of nowhere, so we had the histogram dropped off sharply and went down into negative territory, we usually see this divergence or this downward sloping on the histogram, and it doesn't take a rocket scientist to figure out where things are going. So we see the downtrend, and it worst case scenario, sometimes it looks like we're going to get a crossover with the histogram heading down sharply and the MACD curling down, and it might kick around for a few weeks as the market pushes higher. So those anticipating the crossover may not get it right away, but rarely do you see the histogram come down to these levels near the zero line and then just turn around and punch back up. At least over this entire span of the bull market we're looking at, that has not happened. Every time that it came down and approached that level, we did get the bearish cross. So I wanted to bring that up, and let's take a look at one other indicator that I use very often, and that would be the RSI here, the RSI 14. Now, if we look at the bull market, the bull market since the lows off 2009, real quickly we can take a look at the 3 biggest corrections that we had. Here's summer of 2010, summer of 2011, 2012. In the summer of 2012 as well, we had a correction. Started in the spring, went into looks to be about I'm trying to go from memory here, maybe June or so, July. As you can see, there's a pattern there, and that's the seasonality we talk about, the whole sell in May, go away thing. And so not only do we have seasonality kicking in, but let's look at the largest corrections that we've had in this entire bull market and take a look at the RSI. The red line on the RSI here is a 70 level, which represents overbought readings. When the market reaches 70 or above, that's considered overbought, or any security for that matter on the RSI, and 30 would be the oversold level. Typically, the market's getting extended when you're overbought, and once you exceed that 70 level, you are now clearly into overbought territory. And so if we look at this, the biggest corrections that we had obviously have come off overbought levels on the market. So there we have back in 2010, pretty significant correction, overbought levels here. Market continued to persist. The RSI made a lower high but remained overbought, and then boom, that was the largest correction that we've had in the entire bull market yet. And not coincidentally, it came after the most overbought reading. And where are we at today? Well, once again, we're at levels that exceed the prior overbought levels. So again, I factor all of this in, to the big picture. trend lines, this deceleration in the business cycle. A lot of fundamentals go into my analysis, as well as technicals. But these are a few things that, in my opinion, are I don't want to call them irrefutable sell signals, but very, very solid indicators that the next few months in the market are more than likely going to be downside. And in my opinion, we're looking at more than just a little shallow dip here. 5% buy the dip correction, as a lot of bulls out there are looking for. So again, based on these sell signals, the MACD crossing into bearish territory on the weekly time frame, as well as the RSI rolling off extreme overbought readings and coming now clearly back down below the 70 level and heading lower. It looks like the market's going to be in for quite a possible big move down. It's hard to say at this point how far. Right now I have some near-term targets out on the S&P 500. You can view those on the daily chart, and we'll just have to see how things get going here once a correction does begin. We'll assess it as it goes. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed the video.